If you have money sitting in a traditional IRA right now, there is a deferred tax liability attached to every single dollar in that account. That liability does not belong to you. It belongs to whoever inherits the account after your death. Under current federal law, every dollar your children or beneficiaries withdraw from an inherited traditional IRA is taxed as ordinary income at their marginal rate. If your child is in their peak earning years when they inherit, which most adult children are, that rate is 22, 24, or 32%. If they inherit during a year with other significant income, it reaches 37%. That is not a capital gains rate. That is the highest ordinary income rate in the federal tax code applied to money you spent decades accumulating. Here is what makes this worse. The Secure Act of 2019 eliminated the Stretch IRA provision, which had allowed beneficiaries to spread withdrawals across their lifetime. Under current law, most non-spouse beneficiaries must withdraw the entire inherited IRA within 10 years. A $400,000 IRA inherited by a child at age 52 during their highest earning decade must be fully distributed and taxed by age 62. A lifetime of tax deferral is compressed into a 10-year window, timed to hit your heirs at the worst possible moment. Before going further, two groups of people need to hear this directly, because both are about to make a costly error. The first group is the retiree with a modest IRA, $80,000, $120,000, or $200,000, who believes this is a problem for million-dollar accounts only. That is incorrect. The 10-year distribution rule applies to every inherited traditional IRA, regardless of size. An $80,000 IRA inherited by a child earning $95,000 annually generates $8,000 in additional taxable income per year for 10 years. That pushes the heir into a bracket that costs between $1,760 and $2,560 in additional federal tax each year. Over 10 years, that is up to $25,600 in tax on an $80,000 inheritance, a 32% erosion before state income tax is factored in. The account size changes the dollar amount. It does not change the problem. The second group is the retiree who has already named beneficiaries on their IRA and considers the planning complete. A beneficiary designation determines who receives the account. It does nothing to address the tax rate at which that person receives it. Naming a child as beneficiary of a traditional IRA without additional planning is the equivalent of leaving an envelope of money with a 37% tax lien attached. The planning that matters is not who receives the account, it is what type of account they receive. Here is exactly what this covers. 3 specific strategies for addressing the inherited IRA tax problem before it becomes your family's problem. First, the Roth conversion, the most powerful tool available and the most commonly misunderstood. Second, the qualified charitable distribution, for retirees who give to charity and want to eliminate IRA balances at a 0% tax rate. Third, the strategic use of life insurance to offset the tax liability heirs will face. 2 additional points follow, covering the Roth conversion ladder, the specific multi-year approach that minimizes conversion costs, and the one beneficiary designation mistake that makes every other strategy irrelevant. Everything covered here is grounded in the federal tax code and current IRS guidance. Point 1. The Roth conversion. Paying the tax bill yourself so your heirs do not have to. The most common misconception about Roth conversions is that they are only worthwhile if you expect to be in a higher tax bracket in retirement than during your working years. That framing misses the point entirely when the goal is inherited IRA planning. The relevant comparison is not your current tax rate versus your future tax rate. It is your current tax rate versus your heirs' tax rate at the time they are forced to withdraw under the 10-year rule. For most retirees in their 60s and early 70s whose income has dropped from peak earning years, their current marginal rate is lower than their children's rate will be during the 10-year distribution window. Converting now and paying tax at your lower rate is mathematically superior to deferring and forcing heirs to pay at their higher rate. A Roth conversion moves money from a traditional IRA to a Roth IRA. The converted amount is included in your taxable income for the year of conversion and taxed at your current ordinary income rate. Once inside the Roth account, the money grows tax-free. Qualified distributions from the Roth, meaning distributions taken after age 59 and a half from an account opened for at least 5 years, are completely income tax-free. When your heirs inherit a Roth IRA, they are still subject to the 10-year distribution rule under the Secure Act, but every dollar they withdraw from the inherited Roth is income tax-free. The 10-year forced distribution window becomes irrelevant because the distributions carry no tax liability regardless of when within that window they occur. For the lower-income retiree whose primary retirement income is Social Security and a modest pension, your taxable income in retirement may be low enough that you can convert meaningful IRA amounts each year while remaining in the 12% federal bracket. The 12% bracket for a married couple filing jointly extends to approximately $89,000 in taxable income for 2025. If your combined Social Security and pension income leaves significant room below that threshold, you can convert IRA dollars at 12%. Locking in a rate that your children earning $110,000 annually will never see on their ordinary income. For the retiree with higher retirement income, your conversion window is narrower because existing income already occupies part of the lower brackets. But the 22 and 24% brackets, which extend to $383,900 for married couples in 2025, remain meaningfully below the 32 and 37% rates your heirs may face. Converting at 24% to prevent heirs from paying at 37% is a 13 percentage point improvement on every converted dollar. On a $300,000 IRA, that differential represents $39,000 in tax savings for your family. The Roth conversion increases your taxable income in the year of conversion, which can produce secondary effects. It can push more of your Social Security benefits into taxable territory. It can trigger or increase your Medicare IRM-AA surcharge, and it reduces your IRA balance by the tax paid, money that leaves the tax-advantaged account permanently. These effects must be modeled before conversion to ensure the benefit outweighs the cost in your specific situation. One action to take right now: pull your most recent tax return. Look at your taxable income on line 15 of Form 1040. Calculate the gap between that number and the top of your current tax bracket. That gap is the amount you can convert this year without moving into a higher bracket. Use the IRS withholding estimator at irs.gov to model the conversion amount if needed. The optimal conversion amount is different for every retiree and changes annually as income fluctuates. Do this calculation every year, not once. Point 2. The qualified charitable distribution. Eliminating IRA balances at 0%. Most retirees who give to charity deduct their donations on their tax return. Most retirees also take the standard deduction, which means their charitable giving produces no additional tax benefit because they are not itemizing. The qualified charitable distribution bypasses the deduction system entirely and eliminates IRA income before it ever appears on a tax return. Once you reach age 70 and a half, you can direct money from your traditional IRA directly to a qualifying charity, up to $108,000 per year per account owner. The distributed amount is excluded from your taxable income entirely. It is not a deduction. It does not appear as income and then get subtracted. It simply never enters the income calculation. For a retiree who gives regularly to a church, a nonprofit, or any qualifying 501c3 organization, every dollar directed through a qualified charitable distribution is a dollar of IRA balance eliminated at a 0% effective tax rate, compared to the 22 to 37% rate heirs would pay on the same dollar under the 10-year rule. Additionally, once you reach the age where required minimum distributions apply, currently age 73 under current law, a qualified charitable distribution counts towards satisfying your RMD for the year. Instead of being forced to withdraw your RMD, pay income tax on it, and then donate what remains, you send the full pre-tax amount directly to the charity, satisfy your RMD obligation, and pay no tax on any of it. For the lower-income retiree who gives modestly to a church or local charity, even a $5,000 annual qualified charitable distribution eliminates $5,000 of IRA balance at 0%, rather than the 12 to 22% your heirs would pay. Over 10 years, $50,000 of IRA balance is eliminated tax-free, saving your family between $6,000 and $11,000 in future income tax on money that was going to charity regardless. For the retiree with a larger IRA and more substantial charitable giving, the $108,000 annual limit allows significant IRA reduction. A married couple can each execute up to $108,000 in qualified charitable distributions annually from their respective IRAs, $216,000 combined per year directed to charity at 0%. Rather than accumulating as a taxable inherited balance for heirs. The qualified charitable distribution must be paid directly from the IRA to the charity. You cannot withdraw the money, deposit it in your bank account, and then write a check to the charity. That sequence makes the withdrawal taxable income and eliminates the benefit. The IRA custodian must issue the check directly to the qualifying organization. Most major custodians have a process for this. One action to take right now. If you are age 70 and a half or older, give to any qualifying charity, and have a traditional IRA, contact your IRA custodian and ask how to set up a qualified charitable distribution. Identify which of your regular charitable recipients qualifies as a 501c3. Execute the distribution before December 31st of the current tax year. The tax benefit applies to the year the distribution is made. Point 3. Life insurance as an IRA tax offset. Life insurance is rarely discussed in the context of IRA tax planning because most financial conversations treat insurance and investments as separate categories. They are not separate when the goal is maximizing the after-tax inheritance your family receives. For retirees who cannot complete a full Roth conversion before death, either because the account is too large, their income is too high, or they do not have sufficient time, life insurance provides a mechanism to offset the tax bill heirs will face without requiring the retiree to pay that tax themselves. Under Internal Revenue Code Section 101, life insurance death benefits passed to named beneficiaries are received income tax-free. A permanent life insurance policy, whole life or universal life, with a death benefit sized to cover the estimated tax liability on the inherited IRA, creates a tax-free offset for the tax heirs will owe. The retiree uses a portion of their required minimum distributions, money they are required to withdraw regardless, to fund the insurance premium. The RMD is taxable income regardless of how it is used. The question is whether the after-tax RMD goes towards spending, general savings, or insurance premiums that generate a tax-free death benefit for heirs. For the lower-income retiree taking required minimum distributions, whose RMDs exceed spending needs, a common situation for retirees with pension income who do not need the forced withdrawal, redirecting the after-tax surplus into a life insurance premium converts taxable RMD income into a tax-free death benefit. The net transfer to heirs is improved without additional out-of-pocket cost. For the retiree with a large IRA who cannot convert the full balance before death, sizing the insurance policy to the tax liability on the unconverted balance gives heirs a tax-free payment that offsets the income tax they will owe on inherited distributions. A $500,000 traditional IRA inherited by a child in the 37% bracket generates approximately $185,000 in federal income tax over 10 years. A life insurance policy with a $185,000 death benefit funded by RMD surplus provides a precise offset. The heir receives the IRA distributions, pays the tax, and receives the insurance proceeds tax-free to replace with the tax consumed. Life insurance premiums are not deductible, and the policy must remain in force until death to deliver the death benefit. A policy that lapses due to missed premiums provides no benefit. Insurability is also a constraint for older retirees or those with significant health conditions. Premiums increase substantially with age, and certain conditions may make coverage unavailable or cost-prohibitive. The optimal time to implement this strategy is in your late 60s or early 70s, while premium costs remain manageable. One action to take right now. Request an illustration from an independent insurance agent showing the death benefit available for a permanent life insurance policy funded at an annual premium equal to your current after-tax RMD surplus. Compare the projected death benefit to the estimated tax liability on your current traditional IRA balance, assuming a 30% effective tax rate for your heirs. If the death benefit covers 70% or more of the estimated tax liability at a premium you can sustain, the strategy warrants serious consideration. Bonus 1. The Roth Conversion Ladder. The multi-year approach that minimizes the tax cost. The most common mistake in Roth conversion planning is converting too much in a single year. A large single-year conversion pushes income into higher brackets, potentially triggers Medicare IRA surcharges, and increases the taxable portion of Social Security benefits, creating a compounding tax effect that erodes the benefit of the conversion. The Roth conversion ladder solves this by spreading conversions across multiple years, typically the period between retirement and age 73, when required minimum distributions begin. During this window, taxable income is typically at its lowest point. You are no longer earning employment income, and you are not yet required to take RMDs. This is the optimal conversion window, and it is finite. Once RMDs begin at age 73, the forced withdrawals consume bracket space that could otherwise be used for conversions. The mechanics are straightforward. Each year, calculate your taxable income excluding any conversion. Identify the gap to the top of your current bracket, convert that exact amount, no more, repeat annually until either the traditional IRA is fully converted or RMDs begin and make further conversions less efficient. A retiree who retires at 65 and begins RMDs at 73 has an 8-year conversion window. 8 years of disciplined bracket-filling conversions can eliminate or substantially reduce a traditional IRA before the 10-year inherited distribution clock starts for heirs. Bonus 2. The beneficiary designation mistake that makes every strategy irrelevant. Every strategy covered here, Roth conversions, qualified charitable distributions, life insurance, is designed to reduce the tax burden on whoever inherits your IRA. But if your beneficiary designation is incorrect, outdated, or missing, none of these strategies matter. A traditional IRA without a named beneficiary passes through your estate rather than directly to heirs. An IRA that passes through an estate loses the 10-year distribution option and may be subject to a 5-year forced distribution rule, compressing the tax timeline further and eliminating flexibility. An IRA with an outdated beneficiary designation, a former spouse, a deceased relative, or a trust that no longer exists creates legal complications that courts, not your family, will resolve. Review your IRA beneficiary designation annually. Log into your IRA custodian's account portal and navigate to the beneficiary section. Confirm that primary and contingent beneficiaries are named, current, and correctly spelled. Confirm that the beneficiary designation matches your current estate plan. A beneficiary designation supersedes your will. The account passes to whoever is named on the form, regardless of what your will states. If your will says one thing and your beneficiary designation says another, the beneficiary designation governs. Here is the single idea that connects every point covered today. A traditional IRA is not a tax-free account. It is a tax-deferred account. Every dollar inside it carries a deferred tax liability that belongs to whoever withdraws the money, at whatever rate applies to them in whatever year the withdrawal occurs. The Secure Act compressed the inherited withdrawal window to 10 years and timed it to hit heirs during their peak earning years. The result for most families is that 25 to 37 cents of every inherited IRA dollar goes to the federal government. The strategies covered here do not eliminate the tax. They shift who pays it, when it is paid, and at what rate. A retiree who pays tax on a Roth conversion at 12% is paying a bill that would otherwise fall on their heir at 32%. That 20 percentage point difference is the return on the planning. A retiree who executes qualified charitable distributions is eliminating IRA balances at 0%, rather than deferring them to a 37% inherited rate. The math is not complicated. The only things required are the knowledge that the problem exists and the action to address it while the window remains open. The tax code taxes what you do not plan around. Plan around it. In the next video, the discussion covers the one Social Security filing decision that permanently reduces your benefit by up to 30%. A decision millions of seniors made without understanding the lifetime cost, and the specific strategy for addressing it if you filed before your full retirement age.